use most commonly is historic or future against future working capital plus adding working capital. So on that, I'm looking at my historic profits. I'm looking at my future earnings. I'm multiplying that by a number to say a buyer might be prepared to pay 3, 4, 5 times earnings, 6, 7, 8 maybe in a very good business. And then they're going to want to benefit from the additional working capital in the business. Or perhaps there's debt in there. Well, they won't want to pay for that, so we knock that off too. But some industries, there's a rule of thumb. The most common examples of that are accountants or financial advisors, where it's typical for a business to be sold as a multiple of turnover. So we don't look at profit, we actually look at turnover. And we adjust the multiple depending on the quality of the business. Other businesses might be valued based on their net assets. Property companies, investment companies are your classic examples there. But also there might be a loss-making business could be valued in that way. The classic valuations are by reference to comparable companies or transactions in the marketplace, or by discounted cash flows. With small businesses, they're actually quite difficult, if not impossible to do. The comparable companies and transactions, we'd typically be looking at listed companies for valuations. Now, the difference between a listed company turning over several billion and a small business turning over 1 million, 2 million, 5 million, they're completely different animals. It just wouldn't be a reasonable approximation, even if we could find a similar business. That said, we can cross-check our valuations with market data. There is data out there for sale prices actually achieved for small businesses, and we get an idea of market trends and can sense check what we're doing in a valuation against that data. Discounted cash flows are also difficult with small businesses, not least because most small businesses haven't produced a budget that stretches forward several years, not because they've done anything wrong, but because they aren't able to do so. They don't have the information that enables them to do so. We then move on to dividend yields as another less common method of valuation. They're unusual in small companies because they're only really appropriate where you've got someone who has a minority shareholding but receives a regular dividend each year, which isn't normally the case with an owner-managed business. And then finally, there are some cases where the articles of association or a shareholder or partnership agreement actually give us a methodology and set way of valuing the business. Having established the value of the trade itself by one of those various methodologies, we then have a look at working capital and would add on any surplus working capital or deduct any deficit. Now, that sounds very simple, but people often forget that when thinking of the valuation of a business. And to put it very simply, if you've got two companies identical in all respects, save that the first one has 1 million of surplus cash in the bank and the other one has 1 million of debt, I think we'd all know which one we would be prepared to pay more for. And then, in terms of how I would get underneath the skin of those, the key to it is really understanding the business itself. It's not as simple as taking the company's profits, averaging them over 1, 2, 3 years, looking at the management accounts, and then applying a formula, and then saying, well, you always need 50 grand in the bank, we'll take everything else above that to be surplus. I have to understand the business fully. Not to the level I would do if I was buying the business myself, but if I'm valuing it, I really do need to understand it. So the expectation would be you're going to get a grilling in the same way as you perhaps would from the auditors, because they need to understand the business. I need to understand what it does, the market in which it operates, and the key personnel and their roles. Those matters are all key to determining the multiple, the number of times recurring profits a buyer would be prepared to pay, whether it's appropriate to use an earnings-based methodology or whether I need to go to net assets or a rule of thumb. By way of example, some businesses which have a very secure income stream, a mature market, people need those businesses, you're going to pay more for them, particularly if they're not exposed to one or two customers. They've got a nice diversified customer base. They've got good management teams in place. That's very different to a business that's easy come, easy go, where it's all very transactional. Haulage is an example of a low margin sector, sorry, not low margin, low multiple sector. Equally, a lot of the retail industry, it's very easy come, easy go. Your customers aren't necessarily loyal to you. A buyer isn't going to pay the same number of times earning for that business as they would for a business in another sector. So how would I go about getting my information to do the valuation? Well, the starting point would be the financial information sources that I can lay my hands on. Typically, I want 3 years full profit and loss accounts, and that includes the management information is often produced at the back of a set of full accounts. It says here the statutory filing deadline is 9 months after year end. The beady-eyed amongst you might note that currently that's 12 months, but it is coming back down to 9 months again next year. But even with 9 months, or massively so if 12 months, that information might be out of date and is particularly so at the moment. So I'm always going to need to try and bridge the gap between the last set of published accounts and today's date. I would be looking for management accounts, or if there's no management accounts prepared, VAT returns. At least the VAT returns give an idea of sales and purchases for the period since the last account, and something can be pulled together from that. In an ideal world, I'd also have budgets and forecasts that were fully prepared as financial documents. Unfortunately, they're not always available, but typically management will have a good idea of where they see the business as likely to go in the future. And often quite a lot of reliance can be placed on that. Also, we have other information sources. Now, the figures aren't enough. People say accountants are only bothered about the figures. Well, in this case, no. The figures aren't enough to value a business. You have to understand the business. You have to understand where it's going. Is the income that's seen in the last couple of years accounts secure? Are the major one-off issues that have gone on that would affect it, and therefore mean that it might not be appropriate to use a straight average of the last 3 years? That's often the case. It's actually unusual for a business to have been sufficiently steady that I would want to take a straight average of 3 years. So in terms of getting underneath those results and also getting underneath the skin of the business itself, I'd be looking to speak where possible with key management. That's generally not possible if I'm doing a divorce valuation, and therefore it has to be done in writing. But if I'm doing it for a valuation where I'm able to communicate directly with key management, then yes, I would really want to do that. Another key information source is the business's website and its press releases. It's very common for businesses to put quite a lot of information about themselves into the public domain, particularly if there's something they want to sing and shout about. And that can often show where the business is going and justify a higher valuation. Not surprisingly, people don't normally put the bad news in the public domain, though from time to time you can see it in the media. So-and-so's laid off that many people, made a load of redundancies. Now that would also want to be fed into any valuation. Similarly, there's quite often a lot of information in the public domain about the market in which the business operates. We as accountants also see many clients in our day-to-day role of doing accounts and tax. We know how our clients' businesses are getting on because we talk to them. So we will have a good idea of how particular sectors are doing. That information, it might not be completely publicly available, but to a degree it's public because people are talking about it. There might be industry studies out there which are public, but there's an awful lot more that we can feed into that valuation. And then there's also other information that's been filed at Companies House. Confirmation statements, share transfers, debt that's been secured. There's quite a lot that can end up at Companies House, and it's all useful information. However, there are some cases, before you even get into that, where you might not need to do a valuation. And I mention that at this point, having sort of explained how valuation might be done, to just temper people before we go into too much detail. There are some businesses where the valuation is clear. If it's loss-making and has net liabilities, it may well be that the business is insolvent, and therefore it's worth nothing. However, particularly in today's environment, I would really caution against jumping to conclusions, particularly if the business has been impacted significantly by the current circumstances. There are businesses out there which on paper look insolvent and have been loss-making for the last 9 months, but they're actually fundamentally good businesses. And if and when the government ever allows restrictions to be relaxed, then those businesses are in a position where they should come forward again. People need to socialise, people need stuff. So there will be businesses in those environments that, although they're currently loss-making and might have net liabilities, provided that government support continues, they're actually a viable business. And I'll come back to that in terms of how the current environment and the virus changes our approach to valuation. Investment companies are another one where you might not actually need a detailed valuation, particularly if those investments are liquid investments, stock market investments, shares, for example, or even just a couple of properties, because those assets, we can put a value on them. It might be as simple as going on the stock exchange's website, or it could be a case of we need to send a commercial valuer around. They will know that they will be able to give a valuation for the property. We knock off any debt held against the assets, and we add on any cash in there. And that will give us a value of the investment company. Yes, if there's a minority shareholding, we might need to then think about what sort of discount should be applied, but that's typically much less in an investment company than in a trading business. Another case where the valuation might be clear is where the method of calculation for a particular purpose is specified as an arithmetic formula in the Articles of Association or in the shareholder agreement. It's very common for shareholder agreements to contain, should we say, good leaver and bad leaver provisions. So if someone is deemed a good leaver, they get their market value. And sometimes that might be calculated as simply as 3 times the last year's profit. It's an example, it's not what it should be. It's not necessarily what the valuation should be, but it's what the shareholders have agreed in advance. Similarly, there might be a bad leaver from that company. And in those circumstances, it's very common for the shareholder agreement to say, well, you're only getting nominal value, or you're only getting what you paid for those shares. Where that's the case, there's clearly no point in undertaking a detailed valuation, looking at the company's trade, getting under the skin of it, coming to a number, because the number's already agreed between the shareholders previously. However, I would say for the lawyers, financial advisors on the phone, that if there is something in the articles, it's generally not appropriate for divorce purposes, because the courts will want to look at the actual market value of the shares, not what the parties thought they might agree for it several years previously. The final case where the valuation is likely to be clear is where the goodwill in the business is personal goodwill. Now, some of you might have an idea of what personal goodwill is already. Some of you may not. So I've deliberately put in this next slide that talks about the types of goodwill that there might be in a business. Typically, we break it down into two types. There's personal goodwill or business goodwill. Personal goodwill, by its name, relates to the ability, skills, and experience, contacts, and reputation of an individual. If that individual goes, the business goes with them. Or put simply, the business is the individual. That is very different to goodwill that belongs to a business. That's the case where the business is trading on its reputation. The goodwill could be transferred to someone else. There's a genuine firm there. If one individual left, the firm continues independently. There's goodwill in the business there, and that is valuable. So, classic example of personal goodwill would be a hairdresser. People go to an individual hairdresser or barber because it's that individual and they trust them to cut their hair. Similarly, a contractor, an IT consultant, or similar individual, a one-man band type company, they're typically, there's no real goodwill in the business, it's the individual. That IT consultant is, if they're not already caught up by IR35 and the rules which would deem them to be an employee, they're always worrying about where their next assignment's going to come from and whether they're going to remain someone who can trade through their own limited company rather than as a deemed employee. Those individuals, there's no goodwill in the business. The value of those companies, if indeed those companies trade through a limited company, is the value of the surplus assets and cash held. So moving on from that, we're now going to look at how the coronavirus has impacted valuations. And really, the subtext to all of this is we have a time of huge uncertainty, huge economic uncertainty, as well as huge social uncertainty. None of us really know what we're going to be allowed to do next week, or even tomorrow. And similarly, businesses don't really know where they're likely to be. We've probably got a bit of a better idea now that there's a vaccine waiting in the wings or the first inoculations have happened today. But it's still a case, there's a lot of uncertainty in particular sectors. So we need to have a look at how the sector is impacted so far and how it's likely to be in the future. So the first key takeaway is that the impact on the valuations is sector specific, and even in between sectors, it's likely to change with government policy. Retail, hospitality, that's particularly the case. In the summer, hospitality was actually looking quite rosy. Eat Out to Help Out was a roaring success and people were flocking back to pubs, bars, restaurants. Last month, they were all shut down again. This month, it's much more mixed. It's going to continue to change. And those businesses in that sector are very difficult to value at the moment. And the date of the valuation is absolutely key to what the business is worth. Those businesses will go up and down in value quite rapidly at the moment. And that is my next point, future expectations. Where do those businesses realistically expect to be in 6-12 months? We'll take the assumption that the vaccine proves successful and therefore there is some kind of return to normality within the next 6 or 12 months. That puts a lot of hope into a lot of areas. It means that the valuations of businesses are likely to rise, but we've still got big questions. If you're valuing a retail business at the moment, retail has changed massively. How many of those retailers are still going to be standing after all of this? Last week we saw the top Philip Green's Arcadia empire fall down and take Debenhams with it. There have been other high-profile retail collapses. If you're valuing a small business in the retail sector, has that business got a niche? Therefore, even if it's allowed to trade, what's its future? What's the town or city it's in likely to be doing? Is it a one-off in a struggling shopping centre? That's a very different proposition to somewhere that's got a niche, it's got its bricks and mortar, and it's got a sizable and it's got a realistic online proposition. It looks secure. The classic example on future expectations, though, and why you really need to think about it, can be seen in the stock market on the day the Pfizer announcement came out. The market as a whole raced ahead, particularly those sectors which have been hamstrung by the impact of the virus. But interestingly, companies like Zoom and Amazon dropped. And the reason for that is people are looking forward to where the money's likely to be in the future. The businesses that have done extremely well out of the virus might not have such an easy time of it going forward when there's more competition. Yes, times are changing, which will help them in the long term, but it's not going to be such an easy ride. So how do I then play that into a multiple, the risk, a valuation? Well, I have to come back to how is that particular business affected? I think any business has a higher level of risk at the moment, except for those that have done particularly well because they're a natural winner. A PPE supplier might be the natural example there. Now, increased risk typically reduces the multiple that people will pay for it. Why would you pay for 5 years' earnings if you're not so sure that it's going to come off? You might only be happier with 4 or even 3 because there's more of an uncertainty over that sector, over that business going forward. But on the other hand, it might be a business where this year is a bit of a write-off, but there's no reason to think that that's going to be the same going forward. An example of that I've valued recently would be a business that does air conditioning, supplies, fits, maintains in the office market. Now, this year has been really, really difficult for them because offices have been largely closed. They've had all the problems with distancing. People are delaying projects. But I think people have realised that people need to collaborate. Offices won't cease to exist in the future. They're not dealing with the huge city centre offices where capacity is likely to be massively reduced because people work from home. These are smaller business offices where they need to get people in part-time, temporary. They'll still need a similar amount of space. They'll still want their air conditioning. Now, in that case, I looked at it and said, well, the multiple might be X normally, but because the next year is going to be very difficult, I'm going to reduce that to by 3/4 of a year to reflect the fact that the first year is a bit of a write-off, but someone who's buying you will still see the same business. They're just going to have to wait a year to get it. So that'd be one example where it might come through. Others, it's different for each business. A retailer, for example, it's going to be lower at the moment. There are other businesses where the change in the environment at the moment, the business environment, actually presents them with a big opportunity. And you might be thinking, well, this year's been tough, but the future is actually looking rosy because that's the way things are moving. And in those cases, I might not discount the valuation more beyond where I would normally put it to. But even if I've been able to come to a number on the multiple, the risk association, working capital is also affected. One thing that's come out from the last 9 months is that a lot of businesses who've had significant working capital have actually been very glad that they've had it. It provides a bit of evidence that more of a buffer than might ordinarily have been the case is sensible to be held in a company. So I might be more conservative in terms of what I say is the necessary working capital that our business needs to retain. That means I'm adding less on for the surplus working capital. But similarly, there are also some businesses today that are awash with cash. There's a lot of government support. There's anecdotes that a lot of bounce back loans have ended up in new cars, extensions, etc. What that means is it needs to be looked at more carefully. The fact that a business has £100,000 in the bank today, there might be a bounce back loan for 50,000 of that. That needs to be taken into account as well. How much has the business's working capital really suffered through the last 9 months? Have people stopped paying them? Have they paid them later? Or is it just a case of they took out the loan in April, May time when everything looked very bleak and they haven't needed it? The answer will be different for each business. So unfortunately, the conclusion to all of this is there aren't any fixed answers. Valuing a business is an art as much as it is a science at the best of times, but at the moment there's even more to think about. But hopefully, having gone through this webinar today, I've given you an idea of what we're seeing and what ought to be taken into consideration on a business valuation at the current time. So that concludes today's webinar. The next one we've got is in the new year, when myself and Alison Ward, who's tax manager here, will present a webinar on ideas for how you might pass the value in your business or even your other assets to the next generation. So looking at inheritance tax and capital gains tax consequences of doing so at a high level. We're not planning to go into any particular detail because we could actually fill an entire day if we wanted to go into detail. But we'll be looking at what might be possible rather than focusing on any one type of planning. We know a lot of people will perhaps think about these things over the Christmas break while there's more time on their hands, while they're not focused on their businesses. What am I planning to do for the future? How do I move this on? What's my exit strategy? Is it the next generation? Is it exiting the business? If I've got cash, how am I passing that on to? So it's really to try and build on some ideas people might have had at that time and let you know what might be possible. And then we move on to questions and answers. I don't know if anyone has any questions they would like to raise. Stephen, have you received any?
No, we've not received any, but feel free to use the chat box if you don't want to unmute yourself. There is the chat box in the top right-hand corner of your screen. It's a speech bubble. If you want to put any questions in there, please feel free to do so. Alternatively, if you just click on your screen and turn on your microphone, you can unmute yourself and then you can ask Chris a question directly. So if anybody's got any questions, please feel free to jump in. Whilst you're doing that, whilst you're having a think about anything you might want to ask, we do have a plan of webinars for next year as well, and one of which is Chris has already mentioned, which is this year, and then we're also looking at webinars on pensions and investments, social media, strategic planning, and so on. But if you've got anything that you would like us to cover, please feel free to drop us a line and we can pull something together for you. We've previously had the Brexit webinar. No doubt we'll have to do an update of that as things are changing probably hourly at the moment, as I believe Boris is over in Europe trying to do something about it and trying to get us a deal. But we'll have to update you on that one as well. And likewise, if anybody's interested, I know we have a number of solicitors on the call today. If anybody of your clients are interested in getting some sort of plan for next year and therefore wanting to move forward with some planning for 2021, please get in touch. We have a super system which we're able to roll out to all new and existing clients. We've had one message from Sarah Jones. I missed the start due to an audio issue. I know there's been some technical issues today. I actually struggled to get on myself, funnily enough. So yes, the webinar will be up on YouTube later on today, and all the slides will be there as well. So if you've missed anything, please feel free just to jump onto our YouTube channel, which is Harts Limited, with limited spelt in full, and be able to get a copy of that. Whilst you're there, please subscribe to our YouTube channel so that you'll be able to get notifications of any new webinars that go up on there. We've had one question. What about online retail? We are the fashion brand and we sell to the end user, B2C, from our own website and over 10 marketplaces. We plan to sell in a couple of years' time. Have you any comments for that, Chris?
Yeah, I would say, and this is why I was sort of talking about some businesses really needing to get underneath the skin of them. Now, I've talked quite a lot about retail being hard hit, and in talking about that, I do really think about bricks and mortar retailers. Someone who is purely online retail won't have been impacted in the same way. That sort of business, I would have thought, was able to remain open throughout. It might have had some impact in March, April to do with missing stock, not being able to get stock because of supply chain disruption or because of distancing requirements in the warehouse. But going forward, and since the initial crisis, I would have thought that business has been able to operate. It's also a business that is likely to do well in the future. And therefore, I wouldn't be looking to downvalue that type of business in a way that I would a bricks and mortar retailer, because I don't see it as being at high risk. The problem with an online retailer is that it is extremely transactional, and building the brand loyalty, which is what builds the value in it, is much more difficult, and therefore the multiple is likely to be low in the first place. Okay, thank you. That's okay.
Okay, thank you very much. Anybody else got any questions? Anybody want to unmute yourself? Please feel free to do so. I think that's probably about it for this morning. Thank you very much indeed for joining us this morning. I hope you found that informative. Thank you, Chris, for giving us that presentation. If you've got any further questions or you want to chat something on a one-to-one basis, obviously give us a call and Chris will happily talk through any issues that you may have, any problems you may have, or if you're thinking about selling at some later date and looking at potential valuations. So again, thank you very much indeed, and hopefully you can join us on the next webinar, and have a good week. Thank you very much indeed.
Thank you.
Thank you.
Bye-bye.
Yeah, thanks very much. Bye.
Thanks, Chris.
Thanks, Chris.
Thank you.